900 advances, only 100 declines. We haven't seen this in a long time. Mahesh Patil joins us now. Let's take the conversation forward. Mahesh, you know, if we look at markets always tend to capitulate and then market bottoms are made. Was yesterday's nervousness, it lasted only for a couple of hours, but yesterday's event nervousness, was that a perfect mark of a market bottom?
Well, difficult to say that because we saw some reaction because of the airstrikes, and the market actually, if you look at it, India has been underperforming the global market. So there have been some domestic concerns, and we've seen some kind of underperformance, but it's been moving in a pretty narrow range. And yesterday was a big event where one would have thought that there could have been a larger correction, but I think it found support and came back. So I think for timing, it looks like unless there is any further negative news or further escalation in terms of tensions between India and Pakistan, I think market will probably take that as a bottom, because global cues are also fairly decent. I mean, we're not seeing any major negative. In fact, a lot of the emerging markets have done very well in the last year till date. So yeah, I think looks like things should consolidate over here. But again, I wouldn't say that's the bottom, because any further escalation would mean that there could be near-term risk to the market, which should not really overrule that.
But would you say it would be short-lived, because retaliation is already coming now from Pakistan this morning as we speak? If indeed there is any escalation in the tensions between the two countries, which one cannot rule out, would you say again, like yesterday, it would be a knee-jerk reaction and then that will be bought into soon after?
So I think whenever we see these kind of events, I think markets in the short term, there is a knee-jerk reaction, and until the uncertainty gets over, you wouldn't see a big up move. But I think what post this yesterday's strike also, what has happened is that at least market is expecting now, that believing that the chances of the NDA government have gone up in the elections, because and that is something which post the dust settles down over here, I think elections are going to be the big talk, which will start to really get factored in terms of what are the chances of the NDA coming to power, how many seats they will have, and that narrative will drive the market movement. So I think clearly that has strengthened, at least for the NDA, after this action, and that makes one would believe that post whatever correction happens because of this move, I think there's a good reason for the markets to bounce back from those levels.
Mahesh, the other thing that has unnerved investors has been the issues that emerge when it comes to corporate governance, like the NBFC crisis as well that we saw. Does this liquidity challenge loom over the sector as a whole?
Yeah, so I think we've seen that the liquidity challenge has been there. I think it's eased off considerably after what we saw that erupt in the month of September. The overall liquidity system is good, but availability of liquidity actually to corporates, which are stressed and need that, is still a challenge. And the challenge is what we saw in terms of corporate governance issues against promoter pledging, which saw a good correction in a lot of these companies which have been levered, and also in the small and mid cap space. I think those things have played out to a large extent, and we saw that because of that, the pressure on the small cap and mid cap. So year till date, the small cap index is down almost 9 to 10%. So that is pretty much reflected over there. But I would say that overall liquidity situation and the challenges what some of the NBFCs which have been facing is clearly easing off. I don't see that worsening going forward. There could be some stress probably in the real estate sector, where funding, tight liquidity conditions can lead to stress, but by and large overall one should expect things to ease off, and possibly sometime in April, May, I think the liquidity situation should be fairly good, and we should see normalcy coming back.
The star today is Yes Bank. I mean, what a comeback it's been for Yes Bank from yesterday's lows. Markets were worried about two things: who will succeed Rana Kapoor, and what will RBI finally indicate, or what will be the RBI verdict on their book quality. And on both fronts, I guess markets for the moment are breathing a sigh of relief. But I've also picked up a buzz, ladies, which is that Yes Bank could be doing a roadshow very soon. They need capital. They've not been able to raise capital, and they could be looking at not raising capital via the traditional QIP route, what I've been told, Mahesh, market gossip. Market gossip. They could be looking at getting in P investor. What pretty much Axis Bank did. Because P investors in India, they like the financial sector. And they've made money in the financial sector. It's like, SoftBank loves investing in e-commerce companies because he's made money there. He's got an Alibaba right, he's got an Uber right. So he understands, those companies. SoftBank will never buy a steel plant and Brookfield will never buy an IT company. Yeah. So I think that's how it is. But Mahesh, my question to you is that according to everyone's analysis, Mahesh, real estate sector will be in a doldrums. I don't think you can make a case for real estate to make a comeback. If that is the case, then the demand for steel and cement will remain under pressure. If that is the case, then capex will not pick up. If that is the case, then the consumption cycle will remain strong, but the investment cycle will remain weak. And if that is the case, then earnings will not come back.
So I think real estate sector, I think again, real estate is one of the demand drivers, for whether it is cement, and it's more of in the organized real estate. So there, I would agree that there could be some pressure, but I think in a way, I think that would actually pave the way for the recovery in the real estate sector, because what will happen is you would see a lot of projects, which have been holding up because of the funding which was available. Prices were not correcting. I think you would see distressed sale of assets coming through. So a lot of liquidation of assets could happen, in the case of tight liquidity situation, and that could lead to correction in prices. That could lead to again demand picking up. So I think we'll go through the whole cycle, and that cycle got extended because prices were still holding up. Prices didn't go up, but they were still flat, and affordability was coming up. Interest rates have also been kind of but not to the same extent the prices were correcting. I think post this, you could see probably a sharper correction, and that could lead to whole revival in the sector, not immediately, but say a year down the line. And that's what I think, and even RERA and other things, I mean, it has its own challenges. You would see the new cycle come back in the real estate sector.
What about the GST tweaks that just
doesn't really make much of a difference in a way, because overall net, they don't get the input credit, right? So on that it balances out, but at least from a consumer perspective, I think optically it looks that I mean the prices, I mean there is a lesser cost to it. But I'm not so negative on real estate sector per se, because I think this is a beginning. Probably you will see some kind of stress in the next 6 months. But that will pave way for a recovery back into the sector, where you will see sales pick up, consumption at a lower price point. You will see demand starting to pick up, and interest rate cycle is also not that steep. I mean, it's favorable, as you've seen rate cuts and transmission that will happen. So and I think that should help the revival, because that's one of the large sector in the economy, which can actually help the overall GDP growth to look better, and which has been weak for the last couple of years.
Mahesh, the challenge now is that, whereas, as a channel, we are a big proponent of SIPs, and we are a big proponent that you need to move out of real estate and you need to move out of gold. Last 1 year has not been very gratifying. Small cap investors has been painful. Debt market investors have lost money, and that just gives you this very uneasy feeling at the bottom of your pit. That am I doing the right thing by betting on India? Am I doing the right thing by not understanding what is going on? I mean, my money in real estate, if it is not going higher, it's okay. It's not going down now. Gold, I'm not making money, but I'm losing. At least I'm not losing money. And historically, a equity fund or a debt fund competes with these assets.
Sure.
What would be the explanation?
So I think it's been, I mean, it's not new actually. We have seen these periods, where
even in debt is new.
Yeah, sure. So I think from an investor perspective, I think as long as, I mean, one is not saying that everything should be in equities, because you need to do asset allocation, right? And each asset class will go through a cycle. Sometimes equity will do well, sometimes gold will do well. And as long as the asset allocation is fine, I think these ups and downs, what we see in each asset class, and including equities, I mean, in the last 1 year, right? I mean, equity returns haven't been that great, especially for mid cap and small cap, and that's a lot of the portfolio.
You are sugarcoating it when you say they are not great.
So I think that is, but as long as the asset allocation is fine, I think investors should understand that investing into equities is, again, not looking at 1 year to a return, but looking at 3 to 5 year kind of a return. And fundamentally things are, while there has been a sharper correction, I don't think the things are as bad, as it looks in terms of the broader economy, and even in terms of corporate profitability, how things are shaping up. It's more because of there was some kind of exuberance which happened in the small and mid cap space in CY16 and CY17, and we've seen some normalization of that happening. and slightly liquidity has been lower than what it was earlier. But as long as the fundamentals are improving, though not to the same pace what we would have expected, but steadily there is an improvement, there is improvement in the earnings. So I think given that, I'm pretty sure that whatever correction what we have seen, we will see some kind of normalization over there in the coming years. And from an investor perspective, I would say the valuations are now looking fairly reasonable, especially in small and mid cap space. Now, the valuation, because that's one parameter, okay, when you look at and say, okay, fine, things are now looking fairly attractive. And the mid cap and small cap index multiples, if you look at, they are now well below the long-term average. So that should, I think, investors should draw comfort over there, and there will be some kind of a normalization. And more importantly, the earnings growth, while there has been some downgrade to earnings, what we've seen after this quarterly number, they still look fairly healthy for the markets to really do better over the medium term.
But Mahesh, you think Feb also we will see a decline in SIP flows, as has been the case last 3 months?
I don't know the Feb number, but I think overall equity inflows tracking till date are pretty much in line with what was there in the Jan month.
So it's not that you got
so much on the declining.
No, it's not on the decline. It's the same number which is there. I think it should probably stabilize at the current level, which is around, I think, 7,000 crores or so on a monthly basis.
So you don't have a compulsive reason to sell. I mean, when you have redemption, you'll have to sell,
sure,
right? But as a fund manager, one is that you sell because of market timing, but one is that you sell because of redemption. You don't have any redemption pressures where you don't want to sell, but you're selling because you need liquidity.
No, I think we've not seen any kind of a redemption pressure as such. And in fact, overall in our portfolio also, we've been actually deploying cash in this correction, because we think market valuation in the stock are pretty attractive for somebody.
Give me an example. Private banks, if you tell me, we all know that.
Right.
What apart from private banks?
So there are across sectors, I think, where you've seen, again, there has been a big divergence which is there even at the sector level. So again, in the banking sector, NBFCs, for example, okay, they have now corrected quite well. And again, clearly there is differentiation which is there between the NBFCs. Corporate banks, we've seen the rally again, there has been some kind of a correction. So there could be there's definitely some value over there in the corporate banks. Auto sector is down. Okay, we've seen a meaningful correction on the back of weak numbers, what we have seen. But we don't see that really sustaining beyond the next 1 or 2 quarters. So it could be an opportunity over there. A lot of the PSUs have actually corrected significantly on the back of the consistent flow of supply of paper. But again, the valuations there and the outlook there look fairly, risk reward looks fairly good over there. So I think there are a lot of sectors and companies specifically where clearly the valuations are significantly below their long-term averages.
Right. Mahesh, just wanted to, taking a leaf from Yes Bank and the kind of move that we're seeing, irrespective of whether or not they're, inviting PE players to for additional fundraising or not. But do you think that, while the street was so restricted to an Axis and an ICICI bank, the pool can now extend and become much larger of which private bank should one buy?
So I think overall in the banking and financial, I think clearly the pool has increased, because earlier it was only the retail private banks, okay, which was doing well. We've seen that now coming across, whether it is the corporate banks or even select PSU banks also. I mean, they have, we have seen the overall NPA cycle behind. Some of them had challenges. Okay, we have seen the government infusing capital over there. So I think the overall investable universe in the banking and financial services space has gives a lot of options for one to look at. Even in the insurance sector, we've seen some underperformance over there in the life insurance plays, because some slowdown in growth in ULIP. But again, from a long-term investors, the sector offers a good opportunity. So I think there are much more opportunities now across the spectrum in the banking and financial services space.
Right. Now, since you were talking about valuation, one sector or two, a couple that you don't really get comfort from, although consumption has been the darling, is the consumption space, pharma to a great extent. What's your take on these two spaces? How are you deploying?
So on the FMCG sector, the numbers have been fairly good. We've seen strong numbers coming in by the top players. And overall, rural consumption is picking up. Again, the budget, the boost which has been given to the rural economy should drive consumption. The overall earnings growth in the FMCG sector should be fairly steady. Margin pressures, okay, which were there, we've also seen that with commodity prices coming off, I think that should also provide some levers over there. But clearly the stock valuations are at very high levels. So the returns there would be fairly moderate is what we see, though the risk in volatility in earnings will be much lower. So they will continue to be defensive and continue to trade at higher multiples, but the return, expected returns on the sector would be much more moderate. On the pharma space, clearly, I think while things have improved a bit on the US front in the generic side, people are talking about that the pricing pressure, which was there, which was we've seen price erosion of around 10 to 15%. I think that is likely to moderate down to around 5 to 6%. But overall outlook still remains okayish. We are not seeing any significant improvement over there. It will still remain a stock-specific story where companies having individual strong product pipeline of approvals which can mitigate the kind of a decline in the US generic space will continue to show decent growth. And also companies which are moving up the ladder and getting into complex generics would be able to protect their margins. And domestic pharma looks to be fairly more steady. We've seen steady growth over there, margin remaining fairly decent. So I think domestic pharma, I think, would do better than some of these companies which have got a large US exposure. But by and large, it will still remain a stocks specific, so rather than a big macro trade in the pharma space.
Okay, Mahesh, great to have you in the studios. Thanks so much for taking the time and speaking with us. And it's encouraging that, you know, at least from last month to now, one is not going to hopefully see a decline in the SIP inflows. At best, it should be at least stable.